Hello and welcome to Collin Investing, where we cut through the noise and focus on what truly matters in the financial world. Today, we are diving deep into a series of critical events that are reshaping the investment landscape, from trade tensions and Federal Reserve policies to major moves in the tech sector and beyond. We will not only explore the what, but also the why, and most importantly, the what's next. Let's begin. Kicking off, U.S. Treasury Secretary Benson just dropped the bombshell. New tariff codes are coming, and they are effective the 2nd of April. This isn't a blanket increase. Each country will receive a specific tariff level. But here is the kicker. 15% of countries will bear the brunt of these tariffs. While some nations might negotiate their way out, many are looking at mandatory renegotiations, adding another layer of complexity to the global trade landscape. And it's not just about tariffs. Building on that, Benson also indicated the U.S. is considering significant restrictions on outbound investments. Think of it like this. They're looking to control where American money flows globally. The Treasury is actively working with Congress to draft legislation, and their stated goal is clear: to ensure that U.S. investments don't ultimately undermine U.S. interests. We're talking about further investigations and even potential blocks on certain investments. This adds another layer of uncertainty to the whole situation. So we've established the escalating trade tensions. This brings us to a critical question. How is the Federal Reserve navigating the storm? Well, Chairman Powell is facing a dual crisis: economic turmoil from these very trade wars, and, let's be frank, increasing political hostility. With about a year left in his term, the pressure is mounting. We're talking about a potential recession, triggered by the trade war, all while he's dealing with strained relations with the Trump administration. It is not an easy situation. You might be thinking, okay, trade wars and political pressure, that's tough. But what about the Fed chair on a practical term? Let me give you a sense, and it is not pretty. Powell's tenure has been a trial by fire. He's navigated Trump's first trade war, a global pandemic, historical inflation, and even bank failures. I always use this analogy for describing the situation. Powell is like a duck on a pond, appearing calm on the surface, but paddling furiously beneath the water to stay afloat. And the challenges keep coming. Declining immigration and federal cuts are poised to create a perfect storm, impacting both labor supply and demand. And that's where the real economic danger lies. Remember that trade war we just discussed? Well, it plays directly into a very serious risk: stagflation. We're talking about a triple threat: weaker growth, persistent stagnation, and of course, higher prices for consumers. Now, you can bet Fed officials will be scrutinizing every inflation report, searching for any sign that these tariffs are directly driving up prices. But beyond the immediate data, there's a larger, long-term concern: maintaining the Fed's independence, particularly after the upcoming election. But that's not the whole story. It is not just about inflation and interest rates. While the Trump administration isn't directly interfering with interest rate decisions, there are actions, and they are taking actions that could indirectly and significantly weaken the Fed's independence. We are talking about a potential legal challenge to a 1935 precedent, a precedent that protects regulators from being dismissed over policy disagreements. This could open a whole new level of vulnerability for the Fed, undermining its ability to make decisions based on data and analysis, free from political pressure. With all this pressure on Powell, it is leading to internal divisions. It's not just external pressures, it's also inside the Fed. We're seeing significant internal divisions regarding monetary policy, with some members shifting their stances, becoming more hawkish or dovish. It is not a united front, and that uncertainty extends to the very top. Here is open speculation about Powell's successor, and whispers surrounding former Vice Chair Barr's resignation. It was potentially forced. The key takeaway here: instability isn't just in the markets, it is within the Fed itself, and the plot thickens. Trump plans to nominate Bowman to fill a vacant Fed position. Now, Bowman is widely considered a Trump loyalist, having been initially appointed back in 2018. It doesn't stop there. Another Trump appointee, Waller, has recently been sending out dovish signals on interest rates, which, let's be honest, conveniently aligns with what Trump would likely prefer. So the question is, what is the long-term play? We will see. Now, all the eyes are on the crucial element: tomorrow's FOMC meeting. Let's be clear. It is a pivotal moment for the U.S. stock market. The market is on edge. And to be honest, it is craving reassurance. Reassurance of two things: underlying economic stability, and, perhaps more importantly, a signal that the Fed stands ready to intervene if needed. I personally think Powell will likely avoid making any explicit promises, but he absolutely needs to convey a sense of awareness, a sense that the Fed is attuned to market concerns, that they're not blind to the recent volatility. So, the market wants the Fed to walk a tightrope. They are not expecting Powell to directly target stock prices, obviously, but they absolutely cannot afford for him to ignore the recent declines. It's a delicate balance. I think Bloomberg's analysis hits the nail on the head. We should expect Powell to carefully acknowledge the situation, address the concerns, but without committing to any specific policy actions. It is all about signaling and calming the investors' tensions. Let's shift our focus to the tech world. Specifically, Nvidia's GTC 2025, Jensen Huang's keynote laid out a compelling vision. AI isn't just about deep learning anymore. We're moving towards agent-based AI and ultimately physical AI, where AI interacts directly with the real world. Think robots, autonomous vehicles, all those sci-fi dreams becoming reality. Each of these breakthroughs, Huang argues, unlocks massive new market opportunities. He's not just talking theoretically, he introduced a three-guinea Rubik, Black, Ultra, GP300, Rubik, and, looking further ahead, Feynman. The names might sound complex, but it means non-stop improving capabilities. Let's delve into the specifics. Blackwell is already in full production, boasting an impressive 40 times unit energy efficiency. Looking ahead, Blackwell Ultra GP300 is slated for late 2025, delivering 1.5 times the performance of the GP200. Then comes Rubik, expected in late 2026 with 3.3 times the GP300's performance. And it does not stop there. Rubik Ultra is projected for late 2027. It is a real beast, achieving a staggering 14 times the GP300 performance. And lastly, the Feynman architecture is scheduled for 2028. This roadmap isn't just about incremental improvements. These are substantial leaps in computing power. It is not just about chips. These advancements extend far beyond raw processing power. Nvidia is forging key partnerships with GM for autonomous driving, and I think most interestingly, collaborations with Google and Disney to bring robots from drawing boards to real world. Imagine these robots moving from design studios to the factory floor and beyond. But Huang also touched on quantum computing, positioning it as a critical supplement to AI, particularly for breakthroughs in material science, in drug discovery. Now, while he calls it important, he kept it very realistic. Practical quantum computing, he stated, is still 15 to 20 years down the road. So, it is a long-term view. Huang's vision paints a truly expansive picture. He is projecting that global data center construction will exceed $1 trillion by 2028. That's a staggering figure reflecting the massive infrastructure needed to power this AI revolution. And here is a crucial shift happening. AI inference, where AI applies its learning, is expected to surpass the training market in the next 5 years. This means the application of AI will become even more significant than developing it. To wrap up his presentation, Huang kept it bold and simple, stating that AI is creating infinite possibilities, and with these projections, it is difficult to disagree. So Huang presented this undeniably impressive vision. But how did Wall Street react? Cautiously optimistic, and I would say even less optimistic in the short term. It is not all smooth sailing for Nvidia. They are facing very real short-term margin pressures. Supply chain risks remain a constant headache and, of course, geopolitical challenges are always looming. Keep they brave from analysts I've spoken with, the timing of that Blackwell Ultra release, and crucially the specifics around Rubin. Those details will have a direct, tangible impact on market confidence moving forward. Despite all the buzz, Wall Street's reaction is muted. It is not just a feeling, it's showing up in the data. A recent Bank of America fund manager survey reveals a record drop in U.S. stock allocation this past March. We're talking about a dramatic shift. Allocations plummeted from 17% overweight to a staggering 23% underweight. That is a 40% drop. This marks the lowest U.S. stock allocation we have seen since June of 2023. Tech stocks, once the darlings of the market, have been hit particularly hard with allocations, nosediving to 12% underweight, the lowest level in over 2 years. Now, here is where things could get interesting. While that drop in allocation sounds scary, it also points to a significant potential positive. Ample reserve funds sitting on the sidelines, and Goldman Sachs suggests that the systemic deleveraging we have been witnessing is nearing its end. Consider this. Commodity trading gainers, or CTAs, are currently short $30 billion in U.S. stocks. That's a huge reversal from just weeks ago when they were long $50 billion. This sets up a potential and powerful bullish reversal. If the market turns, these CTAs might be forced to buy back billions to cover their short positions. And you know what that means? A potential short squeeze that could send prices soaring. It will be interesting to watch it. It is not just the US market showing those shifts, it is becoming a global trend. Beneficiaries of Trump's US stock impact, the Eurozone, the UK, and emerging markets are all experiencing an increase. We are not making it. It is pure data. Investor allocation to Eurozone stocks skyrocketed. It jumped 27 percentage points. This is the highest level since July 2021. I would say that it is the largest shift of funds from the US to Europe since 1999, according to Bank of America data. Several factors are contributing to that, including a major policy shift in Germany. And talking about Europe, Germany just adopted a historic expansionary fiscal policy. This bold move is expected to boost the overall European recovery. Now, turning to one company facing headwinds, Tesla. I'm sure all of you are aware, shares are down a staggering 42% in 2025. And it is not a secret, sales are falling, they're losing market share. To make matters worse, BYD is launching faster charging stations, intensifying the competition. Although it is not all bad news, Tesla's direct-to-consumer model offers unique advantages through using real-time data, providing a clearer picture of demand. Let's turn our attention to Google's parent company, Alphabet. They have confirmed plans to acquire the Sarkstreak firm Wiz, and the price tag is hefty, $32 billion. Now, Wiz is a major competitor in the cloud security space, specifically going head-to-head with P&W. But here's the issue that is raising eyebrows, that acquisition price. It represents over 30 times Wiz's projected 2025 revenue. To put it mildly, that's extremely expensive in the tech world, and investors will keep an eye. Let's briefly touch on a couple of other stocks making headlines. SoFi, a name many of you are familiar with. My intrinsic value calculation puts it at $23.10, and it's currently trading around $12. Make of that what you will. Then there is Affirm. It lost its exclusive buy now, pay later deal with Walmart. That's a significant development. However, after the drop, Affirm's valuation sits at a price to free cash flow of 23.5. This might be a level to watch out for. Let's talk about a crucial strategy, especially given the current market conditions. It is dividend investing. The beauty of dividend income is that it can provide a degree of stability, even when markets are shaky. Plus, it can compound nicely in uptrends, boosting your overall returns. But remember, it is not about putting all your eggs in one basket. Diversification is always key across sectors and different types of stocks. One of the biggest misconceptions out there: dividend investing is for retirement only. That is simply not true. Compounding dividends, reinvesting them, it is a powerful tool for building wealth regardless of your age or investment timeline. We have seen the power of compound, so let's put it in practice. Dividend investing, and remember, it is not a get-rich-quick scheme. It is a long-term game. It is not about what you earn in that first year, but rather setting a process. For example, take a $20,000 portfolio, add $1,000 each month, with an average yield of 3% and a growth of 12%. In year one, you would earn $600. It does not sound much, right? But fast forward 25 years, it is over $100,000 in annual dividend income. That is the snowball effect. Reinvesting those dividends and consistently adding new money. And that's a wrap on today's deep dive into the markets. We've covered a lot, from trade wars to tech giants, and even how to build a robust dividend income stream. I hope you found it all informative. Now I want to hear from you. What are your thoughts on the current market outlook? Which of these factors do you think will have the biggest impact? Let me know in the comments below. And of course, if you found this video helpful, please give it a like. Subscribe to Collin Investing for more insights and share it with your friends. Let's navigate these markets together.